Okay. So traditional capital asset pricing model, and this is what I was using on the spreadsheet to calculate alpha as one of our performance measures. And the reason I'm emphasizing emphasizing this with you in the models is because what we're going to do today is look at using a couple of other benchmarks besides just the market portfolio, which all boils down to linear regression. Okay, so this was the original CAPM. French and Fama added two more variables to this, which are, okay, small minus large, which is a size variable, and high minus low, which is your book to market, or market to book, whichever it is, market to book ratio. Okay, so when they added this, what they argued and showed was that these variables actually had more explanatory power over stock returns than the original capital asset pricing model. Okay, and then we had Carhart come along not too long ago and add one more variable to that, and that was the momentum variable. Okay, so when we add all of these in, the more we add in, the original CAPM loses its explanatory value. Okay, what I suggested to you yesterday, this is just my own suggestion for your interpretation, is that, you know, at the beginning of this, two class periods ago, I guess it was, I gave you kind of a tree of approaches to investing. Okay, you know, the fundamental, the technical, and then within fundamental value and growth. Well, the momentum variable is based exclusively on past prices. That is that's a definition of technical analysis. Okay, so I suggest to you that this momentum variable is kind of attacking the technical analysis part of this. High minus low. Okay, this is a value ratio. Okay, so this is kind of attacking the value angle to investing. And by the way, when they came up with this variable, because there was another paper on this, they compared this basically to like earnings per share and price earnings ratio and all these other things, and they argued that this variable was more important than all of those. I have a couple of examples of some things that I'm going to do in here, but if Fama were teaching this course, he would say, well, you don't need to worry about all that because this variable takes away all of that. And I don't know that I completely agree with that. But in any case, we have a value variable, and in a way, you know, this one we could kind of argue about, I guess, a little bit of debate. I don't like using the word argue, but debate. The size, we could kind of look at it in a way as a growth variable. Okay? So those general approaches, I think, are at least somewhat represented in this model. It's called the Carhart four-factor model. Okay? So what we were doing yesterday, kind of towards the end of class, focusing just on the capital asset pricing model of this, is the CAPM way of investing, I guess we could say, is a risk-based approach. All right? You guys have all seen your security market line. All right? So you've got your return risk relationship as measured by beta. You've got your security market line, one market risk-free rate, okay? And the way that the CAPM would argue that you approach investing is from a standpoint of risk, okay? So we're going to identify our risk based on beta, and that will determine our return. Okay? And that's what I was telling you guys yesterday, that if you were going to use this in the real world, and you get all the CAPM information with your brokerage statements and online and all that kind of stuff, you get all that information. So if that's what you were going to do in the real world, okay, the example I gave to you yesterday was, I think I said you had a portfolio with a beta of like 0.73. Well, you would argue, well, you know, at 22 years old, I want a higher return than this right here. So how do I get that? Well, you ramp up the risk of your portfolio, which is to say, sell lower beta stocks and buy higher beta stocks. So what you're trying to do is to identify the beta of a stock which will drive higher returns. Well, what we saw in our spreadsheet yesterday was that using last year's beta, okay, and that's what we did on this, is we used last year's beta to form our portfolios in an attempt to get higher returns the next year. That was the point of what we were doing yesterday. Okay? And what did we see when we did that? Would it have worked over this time period? Where if we had invested in higher beta portfolios, again, simplified example because we're only looking at 3 stocks. Okay? But these results are consistent with what they found in their real study. Would it have worked? No. Because what we saw somewhere on here was that the highest subsequent returns actually came from the middle beta portfolio, not the highest beta portfolio like we would expect. Okay? So that's what we saw. So that being the case, then what the next step, if you were determined to use this as your investment approach, then the next step would be, well, we need a better method for predicting beta. Okay? And that's what we did right at the end of class. Over here, where I gave you these 3 methods. Okay? Remember, I wrote them on the board right here. You know, I struggle to remember people's names, but I always remember exactly where I wrote something on the board. Don't ask me why. Okay? But I wrote it right here. Remember where the 3 methods were? We're simply going to use last year's beta, okay? And then we're going to use the, not Charles Schwab, the Merrill Lynch approach, where we're going to weight the betas, 2/3 and 1/3 and 1/3 and 2/3. We did all that yesterday. Again, the theory behind that being that over the long term, betas are going to mean revert to 1. Okay? So that's what this was about, because what we did here didn't work very well. Just using last year's beta and forming portfolios off that didn't work very well. Okay? So the next step would then be to try and come up with some method of actually predicting beta. Okay? And you could probably do a whole course just on that if you really wanted to, because there'd be a lot of econometric issues in that. However, in our simplified version of that, we found that method 3 was the most accurate of the ones that we looked at. Okay? So, if we wanted to take that one step further, which we won't, but if we did, then we could use that method instead of forming portfolios off of last year's beta. We take last year's beta and then use this forecasting method to come up with new betas, and then form portfolios off of that. Okay? And what that model would do is all of the stocks with a beta of less than 1, it would pull it up, and all the stocks with a beta of greater than 1, it would pull it down. Okay? And so forth and so on. So that's the point of what we did yesterday, in addition to looking at calculating alpha, which is a key performance measure. Okay? So that was the point of what we did. What I put together here, I gave you a couple of additional examples of potential approaches to investing. Okay? And this is going back to what I wrote up here at the very beginning. Okay? You have this in your notes. Tech, fundamental, value, and growth. Okay, so it's going back to this. And if we start over here on the left, then actually they talk about this in your book. Under value methods for investing, what we're trying to do is we're trying to come up with a value for a stock. Right? Okay. There's a key issue that I think you need to understand. In fact, I was telling you guys a little bit about this yesterday, but I have a paper that's coming out, which is published, going to be published in a couple of weeks or so, and this is actually one of the points that I'm arguing in the paper, is that we can attempt to value a company, but at the end of the day, do we really know for sure what the value of a company is? No. Okay? For a whole array of reasons. One is what we're trying to value is future cash flows. And we don't know exactly the amount of the cash flow. We don't know the timing of the cash flow. And then we get into discount rate issues and these other issues that we've talked about. But also understand that for example, our primary source of information are financial statements. Financial statements, this is why I took you through the first 2 weeks that I did in this course. Financial statements are full of estimates. Okay, so financial statements, final exam review, the purpose of the financial statement is to most accurately reflect the underlying economic reality of the firm, but that's just an estimate. We don't know exactly what is, and that's before we even start talking about earnings management, which we did earlier in the course. Okay, so my point being that another reason, and probably a bigger reason, that we don't exactly know what a firm is worth is because there's a lot of noise in the data. Okay, there's a lot of noise in the data. Okay, so these are just estimates. At the end of the day, we really don't know. What I argue in the paper is that because of that, we're actually all noise traders. Because some of the more traditional finance people will say, well, you have noise traders and then you have informed traders. Okay? Well, I don't think there are really any truly informed traders. Now, you might say there are naive traders and unnaive traders. You might make that argument. But those informed traders assume that the fundamental information that you're getting is good. And even the audited financial statements are full of estimates and therefore full of noise. Okay? So what I argue is we're all noise traders, even if you're investing for a 30-year time horizon. Okay? With that said, we can still take some shots at trying to value a company. And they talk about this in your book. Under value, you've got, kind of like with your Excel function, you have absolute value models and relative value models. Okay? And absolute, really what I was talking about just a minute ago, are absolute value models. Okay? Where we're going to come up with a value for this stock. Okay? One, which is the first one I have on here, and I'm quite confident that you're familiar with this, is the dividend discount model. Okay, so I have this sheet on there just as a reminder. This is kind of like time value of money, so I'm not going to insult you by going through all of this again. But dividend discount model commonly taught in finance courses. Okay? Well, what I did was I just put together a couple of examples. The first one is using the dividend discount model. I picked IBM, McDonald's, and Coca-Cola just as some examples. Basically arbitrary, outside of the fact that they're all in the Dow. But other than that, and that they're well known, I mean, you guys all have at least heard those names. Other than that, I kind of arbitrarily picked them. I put together their 2012 dividends. All right. The required return and the growth rate is a whole conversation in and of itself. And that's kind of part of my point of this. Okay? We could go back because you know that theoretically, with the dividend discount model, your required rate of return is going to be based off of, first of all, we talked about this yesterday. The first variable is going to be risk-free rate, okay? And then a risk premium, which will be based on your opportunity costs. You probably heard in your corporate finance class, if you will recall, that your cost of capital would probably be a legitimate starting point for a required rate of return. Because if you're paying, 8% on your debt, why would you invest in something at less than 8%? Just generally speaking. Okay? So that, we can have all those conversations, but this is really the point of this example that I'm showing you. So what I did was, just as an opening conversation, I just plugged in a 12% required return simply because that's what large caps have roughly averaged per year over the long haul. And then a growth rate of 3%, and this growth rate in the dividend discount model would actually reflect what? Dividends, required return, minus growth rate. gives you the value of the stock at time 0. What does this growth rate reflect? Yeah, it's going to be the growth of the dividends, and according to the dividend discount model, dividends are based on earnings, so the growth rate of dividends is the same as the growth rate in earnings. Well, it's not that clean in the real world. It's not that clean in reality. And to be honest, I didn't have time to go back. I mean, we could look back at the average growth rate of dividends over the history, particularly with stocks like this. I mean, we could do all of that kind of stuff. But again, just as an opening conversation, I just plugged in 3% figuring inflation. Okay, so at a minimum, they probably want to keep up with inflation. So those are just for opening conversations. And what I did, and this is the actual stock price at the end of 2012, that got cut off, but that's at the end of 2012. There we go. So these are the actual stock prices at the end of 2012. And these are the values based on the dividend discount model. Pop quiz. I actually made a mistake in here. What is it?
Dividend 1.
Exactly.
Dividend
Very good.
Time 0.
Yeah. This is actually dividend 0 at time 0, and what you want is dividend at time 1. So I would need to, how do I fix that? It's 1 plus, so I just need to calculate the future value of it. That's in what, D5? Alright, so here's what the dividend discount model says the stock is worth. Here's what the stocks are actually trading at. By the way, this is in 2012. Quite a substantial difference. Quite a substantial difference. I don't ever recall seeing a stock where the dividend discount model value was anywhere close to the actual stock price. Now, does that mean that the stock price is right? No. But these are the results that I've always gotten. And I mean, I own McDonald's, and I'm quite certain McDonald's is worth more than $30 a share, $31 a share. Am I 100% certain? No, but I think it's hard to make that argument. Sir?
What'd you change to change the dividend 0?
On the spreadsheet that I posted, I just have B5 in the numerator, which is that's the dividend at time 0. But what we want is the expected dividend next year, which is dividend at time 1. So just calculate the future value of this at the growth rate. So far, so good? Okay. Well, as you guys know, we can flip the dividend discount model around to come up with our expected rate of return. And another way of looking at that is to say, well, we can use the dividend discount model to try and infer from the market what a appropriate required return is for this stock. Said another way, if the stock price is actually correct, what does that tell us about the required return? And that's what I'm doing right here. Okay. So assuming a growth rate of 3%, then the market is saying that our expected return on IBM is 4.7, McDonald's is 6.2%. That sounds kind of low to me. And again, that's assuming a growth rate of 3%. Okay, so my point being, this is an example of one absolute value model where we try and come up, and you guys have all seen this before, where we actually try and come up with a hard number that we say, hey, this is the value of the stock. I've never been a big fan of this, at least not by itself. Okay? And what I did, just to kind of simplify things a little bit, because your book has a little more sophisticated earnings model in it, but down here I did this exact same thing, except I used earnings instead of the dividends. So I'm calling it an earnings discount model. Okay. So down here doing the exact same thing, and now our difference between this absolute value and what the stock market is saying, understanding market efficiency, which says that there are very, very smart people out there with a lot of money that have incentive to get it right, and they're all trading based on all known information. So if they think the stock is overvalued, they're going to sell it. If they think it's undervalued, they're going to buy it. Okay? So this is getting us into a little more real world, or more believable numbers, let me put it like that, but we're still coming up with a difference. All right?
Is, when you do the earnings per share, do you add the growth rate like you did the dividend too?
Yeah. Okay, so again, really the broader point here is just some examples of how you could approach investing. Okay, one of which is by attempting to calculate the absolute value of a stock. Okay. And I mean, for all of those, particularly technical analysis, which is really my area, I mean, I can do a whole semester on technical analysis. So these are just examples. Huh? I would love to. If you could talk them into it, I'll be happy to. I'll be happy to do that. Okay.
That's,
I would never get tired of teaching that. Okay, so another, so this is, again, those are kind of the absolute values. Another group of models, or another approach that you could take, is relative value. Okay, and with this, at least in my opinion, we're kind of conceding that we really don't know what the value of the stock is. What we'll do is we'll either look historically at the same stock, or compare that stock to other stocks to determine the value of the stock relative to other values. Okay? Remember back in ratio analysis, we said that we could use ratios for two types of analyses. Final exam review. Those are industry analysis and trend analysis. Remember we had that conversation? So this is the same thing that we're doing here. And what I did here is I just put together a simple example. Again, same stocks. And these are the earnings per share for each stock. I pulled those earnings off of, MSN Investor, which I've never known them to be too terribly wrong, but to the extent there might be minor errors in there, I'll blame it on them. But the earnings are all off of MSN, and then the year-end stock prices. And probably one of the most common relative value models, if you will, is the PE ratio, which of course stands for price earnings ratio. Okay? So simply the price of the stock divided by the earnings of the stock. And what's the interpretation of the PE ratio? When you listen to Kramer on CNBC, what does he say? Yeah.
For every dollar that you're spending, how much they're earning, the company's earning.
Okay. Anybody else? The way that I've always looked at it, the way I usually hear it is, this is how much you're paying for the earnings. Okay? How much you're paying for the earnings. So the higher the PE ratio, the more expensive the company, the more expensive the earnings. Okay? I have a note here. If you flip this around, then what you get is what's called the earnings yield. So when you go home and look at this, compare the earnings yield, which would be the EP ratio, to, I actually said dividend discount model, I meant the earnings model. So I need to correct that. So I was cranking this out this morning. I actually meant the earnings model. Okay? But just when you get home, compare those two and tell me what you get. Okay? But in any case, so here are the PE ratios. All right? And well, let me say two things about this. One, looking at IBM first of all. Okay, here are the historical PE ratios for IBM. All right? Again, we're not trying to identify exactly what the stock is worth. What we're looking at is historical valuations of the stock. How has the market valued this stock historically? Okay. Well, just casually glancing through this, you can see, excuse me, back here in 2003, it looked very expensive. Down here in 2008, it looked very inexpensive, which is not surprising because in 2008, what happened? The market tanked. The market tanked, which in my opinion is actually an argument against market efficiency, because you can't tell me that the value of everything changed that much that quickly. Maybe you could tell me that, but I wouldn't believe it. Okay? So that's not real surprising. Point being that if you were going to trade based on historical PE ratios of this stock, then you'd be looking at buying down in the, say, 10 or below, and selling at maybe what, 15, 16, 17 or above. Okay. So you might approach it that way. Word of caution, if you have never actually looked at these numbers, PE ratios are not always stable over time. Okay, when I've incorporated these into my models, what I've noticed is a trend. Okay, that tend to go up over time. And I think all the ones that I've looked at tend to go up over time. Some of them might have gone down. But if you calculated, the average PE ratio of this time period and compared to the average PE ratio over this time period, probably wouldn't be the same. Okay, so just a word of caution on that. So that would be your trend analysis. What I did in this example, in this simplistic example, was simply compared them to each other. Okay, so this is IBM, this is McDonald's, and this is Coca-Cola. Right? And what I did down here, and this is getting into the important part of this, is calculated the holding period returns as a benchmark. Okay, we were talking yesterday and a little bit this morning earlier today about the market portfolio being the benchmark. Okay. Well, in this example, rather than using the overall market as a benchmark, I'm actually using an equally weighted portfolio of these three stocks as a benchmark. So, in other words, in this example, you have two choices. One is to buy an equally weighted portfolio of all three of these stocks. The second is each year buy the stock with the lowest PE ratio. And that's what I'm doing right here. Okay? So the first year, for example, McDonald's had the lowest PE ratio. So that's the stock, I'm sorry, it actually for 2004 had the lowest PE ratio. So you would have had this return right here. Okay? And so forth and so on. And here are your portfolio returns. Okay? Is everybody with me? I don't believe it. I don't believe it. Okay. Here are our stock prices. Right? And annual stock prices at the end of the year. Here are the holding period returns for each of those stocks for each year. This is your P1 divided by P0 minus 1. Okay? So far, so good? Okay? As a benchmark, all I did was calculate the average of those, which would be an equally weighted portfolio of these three stocks. Okay, so this is your first investment alternative. Okay, you have an investment universe of just these three stocks. Okay, this is your first alternative. This is just buy an equally weighted, and you'll actually rebalance it every year. Okay, but other than that, you leave it alone. If you had done that, this would be your average returns, and I'll get down to this stuff in just a second. Okay? Everybody with me? Okay. Your second alternative, using an absolute value approach to investing, is to buy the stock with the lowest PE ratio. Now, if you were doing this for real and you were forming portfolios, it's the same conversation. You know, you might be analyzing all 30 stocks in the Dow, for example. And you buy the 5 stocks with the lowest PE ratio, or something like that. So this is a simple example, simplistic example of what you might do in the real world. Okay? But in this simplistic example, rather than just simply buying and holding an equally weighted portfolio, what you're going to do is you're going to buy the stock with the lowest PE ratio. So again, right here, assuming I did this right, I hope I did.
Looks like 2008 should have been negative 24 instead of 21.
Shouldn't that be the minimum of C through E?
Do I have an Excel error in here? Okay, what we should not, okay, if C24, which is this beta here, so we're good there, if that's the minimum of these, which is for 2004, no, that's right. All right, you scared me for just a minute. All right, so what I'm saying is, okay, we're talking about row 24, which is right here, which is the year 2004. With me?
Mm-hmm.
Okay, so if McDonald's has the lowest PE ratio for the year 2004, which it does, then we're going to buy that stock at the end of 2004, and we will receive whatever return it is for 2005, which had better be in D37, which it is. Okay, so this is the return for 2005. All right. You scared me for a minute, but it looks correct. Okay. So again, all you're doing is you're looking at 3 stocks at the end of the year. And in reality, it would be a little, there'd be a little more to it than this, because earnings aren't going to be released until probably about 6 weeks after the year end. So we'd have a little lag. So I mean, there's some frictions that we would have to deal with. But again, simplistic example, all we're doing is we're looking at these 3 stocks. At the end of the year, whichever stock has the lowest PE ratio, we're going to buy that stock and hold it for the next year. At the end of the next year, we look at 3 stocks with the lowest PE ratio. We buy that, sell what we had before, buy that stock, and hold that for the following year. So forth and so on. Okay. Does that make sense?
Mm-hmm.
Okay, good. Okay. And that's what I have here. So we're making that decision, and whichever one has the lowest PE, I'm plugging in those returns from over here. So this is just a working area, and your portfolio return would be this here, which of course is whichever return it is. So this would be the returns to your portfolio doing it that way. Understanding in this simplistic example, you have a 1-stock portfolio. Okay. So far, so good? Again, just one of many. Instead of using the PE ratio, French and Fama says, well, really you should be using the market-to-book ratio, which I would actually agree with, but it was easier to find the PE ratio than it was the book-to-market ratio, so I use this instead. Tell me this side. Plus, PE ratio is a lot more commonly quoted than this. Okay, so again, just an example of a relative value approach to investing. So how did it do? And this is, in my opinion, this is really the important part right here. Because again, I was telling you about this yesterday. I mean, talking about all of our investment strategies, that's the fun part. Okay? Where you got to roll up your sleeves and get dirty a little bit is figuring out whether you got lucky or whether you're actually skillful, whether there's actually something there. Okay? So I argue that this is really the important part down here. Okay? So our benchmark return was 14.2% annual return over this period. Our relative value strategy had a 15.3% return, which on the surface looks pretty good, but you guys know there's more to it than that because that's not considering
Commission costs.
well, yeah, true. Commissions, you know, and again, we're going to have some timing issues with the release of earnings and all that kind of stuff. But more bigger picture, it's not considering, I think you just said,
Beta.
well, risk. Risk. Okay? Something I always tell the the entry crowd is we all know that 15 is greater than 14. We all know that. You don't have to go through 4 years of college to know that. We all know that. Okay? What most people don't understand is the second half to the story, and that is risk. And what I did here as a measure of risk, rather than beta, at least for the moment, is use standard deviation. Okay? And we're going to talk about standard deviation in a minute when we get to chapter 12. But this is using, and by the way, here's your average, so I'm doing is averaging the returns. And then the standard deviation, notice this is very important. This is very important, really important. Notice the function that I'm using, because you actually have a couple of choices, but what they boil down to is standard deviation P, which is what I'm using, and standard deviation. What's the difference? We're going to talk about this in chapter 12 in just a minute, but just to make sure we're on the same, just as an entry conversation, what's the difference? Okay? No, P is not portfolio, P is the population. So this one is assuming that what we're dealing with is the population. This one, we're assuming we have the sample, and we're trying to project the population's standard deviation. Okay? We'll get back to that, like I say, in chapter 12 in this other spreadsheet in a few minutes. Okay? So just as an opening conversation. So for now, this is the standard deviation. Well, we got a 14% return with a 15% standard deviation on our benchmark. 15% return with a 22% standard deviation on our relative value strategy. What does your finance instinct tell you about a relative value strategy as executed here?
It's more risky.
Yeah. Looking back, which one would have been better off? Which one should you have chosen? Yeah, the benchmark, because I mean, just as intuition, okay? Because even though 15 is higher than 14, your risk is a lot more. So just a gut feel looking at these numbers tells us that we're probably not being adequately compensated for that additional risk. Okay. Again, seeing a few heads going in the north-south direction, that always makes me feel good. Okay. So, and if what I said doesn't make sense, say something, because this is important, in my opinion. This is important intuition for graduating finance majors to have, the risk-return relationship. We all know that 15 is higher than 14. We all know that. We all know that. Okay? But just looking at the risk, it doesn't look right. Because this is higher than that, of course, we would expect this to have more risk than that. But a proportionate amount of risk, which is what the whole point of this CAPM is about, is proportional risk. Okay. How can we quantify that? Actually, there's two ways. One of the ways your book talks about it, and another way I assume you've heard in other classes, but you might not have. But how can we quantify that intuition? Using standard deviation. Something, eating something that smells really good. Peach or something? Well, your book talks about the coefficient of variation, which is standard deviation divided by returns. You see that on I've got a spreadsheet coming up where you see this, and I think you do that on the homework as well. Okay. Well, that is basically the inverse of the Sharpe ratio. How many people have heard the Sharpe ratio? Okay, good. So the Sharpe ratio technically is calculated how? Okay, it's return minus risk-free rate. So in other words, the risk premium over standard deviation. So like I say, it's basically the inverse of the coefficient of variation, except we throw the risk-free rate in there. This is a second, well, I mean, if you wanted to, I'm looking at these as one. Okay, if you wanted to look at them differently, then you could say a second and a third performance evaluation measure. Okay. But remember, from what we did yesterday, alpha is one performance evaluation measure. Sharpe ratio or coefficient of variation is another. Okay. And that's what I have on this line right here. And for simplicity, you're welcome. I'm assuming risk-free rate of 0. So in other words, just kind of ignoring the risk-free rate. If you don't like that, I'm using the inverse of the coefficient of variation. If you don't like that, I'll change that to CV and use the coefficient of variation. Okay. But as one performance evaluation measure, what I'm doing is I'm putting the Sharpe ratio in here. And this is quantifying our intuition that while we have higher return, we also would expect higher risk, but that risk is too much. Okay. Because the interpretation of this Sharpe ratio is return per unit of risk. Return per unit of risk. And that's what I have in here. Of course, if we're comparing two investments, would we prefer a higher or lower Sharpe ratio? Maybe I shouldn't say of course, but which would we prefer, higher or lower? Higher. We want a higher Sharpe ratio. And that's exactly what we're seeing. Our benchmark had a Sharpe ratio of 93. Our relative value strategy had a Sharpe of 71.
Can you explain why higher is better, like I didn't get it?
Because the interpretation of this is return per unit of risk. So what we're doing is we're standardizing the risk. So for every unit of risk that we take, what's our return? And from that perspective, you would always prefer higher. You'd always prefer maximum return. Okay? And I don't know how far you got into this investment analysis or any other courses. You could actually prove this, and I won't take the time to do it, but you could prove this by, even though this, how could you increase your returns from 14 to 15.3, at least in hindsight? Because on the one hand, I'm saying, well, you're not being adequately compensated for that, so you should have accepted a 14.2% return. But if you thought about it a minute, and if you didn't really know anything about this stuff and you were just thinking about it, you'd say, well, but wait a minute, but I would still prefer 15% to 14%. So 15 is still better. What's the counter argument to that? Granted, in hindsight, but all of this is in hindsight.
Because if you lost,
No. That is a true statement, and that's what we're arguing, but the counter argument to that is, yeah, but 15 is still better than 14, so I'll take 15. The counter argument to that is, well, I'll still get you 15, but how will I do it? I can still get you 15, but with less risk than the relative value strategy. Margin your account. Margin the account. So if you borrow money, then that will raise your return. Of course, we would have to factor in the interest that we would pay on it and all that kind of stuff. Okay. But that would get us up to a 15% return, but standard deviation would not be 22%. Yeah.
but how does that apply? Because they could also margin.
Hmm?
They could also margin or 15.3% return.
Yeah, and then their risk would be higher.
So would ours.
But what-
It would be
no.
an equal,
No. I'm coming in off the street, and I don't know anything, and you're telling me that a 14% return is better than a 15% return. And I'm saying, no, it's not. I want a 15% return. You would say, well, there is a more efficient way to get that return than this relative value strategy. And the way you get that is by, instead of doing this, you pick your equally weighted, you margin your account to whatever is required to get you up to 15%, which would probably be, I don't know, 10% of the account or something like that. That would also increase the standard deviation, but not up to 22%. Therefore, if you did that, you would still get a 15.3% return, but you would get it with less risk.
What a little more than 15%, like 10% on that. Would it correlate equally, like, you say 10% of the account, would that weight the risk 10%?
Well, I was just going on gut instinct, you might margin. I don't know exactly how much you would have to margin. It wouldn't be very much. Okay? Look at it another way. If you wanted to get, let's do the number simple, 14%. If you wanted to get a 28% return, how do you get that? You margin your account 100%, not that you could do that, but if you could, for every dollar you invest, you also borrow a dollar. Right? That gets you up to a 28% return, so it will double your return, and it will also double your risk. So that would get you from a 15% standard deviation to a 30% standard deviation. Again, before we start talking about transaction costs, interest, and some of these other real-world frictions that we'd have to dial into it. Again, point being that with this portfolio, you're not being adequately compensated for this additional risk, as proven by the fact that you could get the same return with lower risk by simply margining the account. Questions? I hesitate to ask. Have you guys gone through that before? Again, it depends on who you had for investment analysis and all this other stuff. Okay.
I do have one question.
Yeah.
The purple side of the spreadsheet, that's the relative, right?
Yes.
Which one was the absolute? Where did you
The other
get that?
sheet.
Oh, you have it completely separate.
Yeah.
Okay, thank you.
Okay. I threw this in here just because people like to see it. Period. If you wanted to look at it a little more closely, which I really don't want to do, but if you invested in equally weight, value of 10,000 would be 26.7, and your relative 27.1, which is only a little bit higher. So not very convincing.
Not very convincing that it was worth the risk, is that what you're
Because of the
saying?
whole conversation we just had.
Okay.
Okay. And I will wrap this up in one sentence. This last part down here is doing the exact same thing, except using the S&P 500. Actually, it's the S&P 500 spider as your benchmark instead of the equally weighted. And in this case, pretty much any strategy would have beaten this benchmark. Which brings us back to the conversation that we had yesterday of, well, what's the appropriate benchmark? Which starts getting into conversations of benchmark error. Okay. Oh, I forgot one other thing. And that is alpha, and we did this yesterday. Okay, so this I threw in alpha as a second benchmark. So we went through all of this yesterday. I'm using the intercept function, and instead of the return on the market, I'm using the equally, in the first example, I'm using the equally weighted. as the benchmark. Second example, I actually am using the return on market as the benchmark. Okay, so again, talking about investment strategies is fun. The important part is rolling up your sleeves and looking at performance evaluation to see, hey, I made money. Well, did I just get lucky, or am I actually skillful? And that's a big part of what we do in academics. A lot of people out there don't like to hear that. I've irritated more than one person, not on purpose, just that's the way it is. Because we all get lucky. Questions? Because I thought this was kind of easy, but I'm beginning to think that it's not as easy as I might have thought it was. So I guess what I will do is let you stew on that. If you have questions, we can go home and look at it, and we can revisit it tomorrow. But these are just real-world examples of two different value approaches to investing. And that is absolute value versus relative value.
Did the holding period returns, was that just price returns, or did that include the dividends?
I believe that included the dividends, because I
Okay.
used the adjusted close.
Gotcha.
If it didn't, my mistake. Glenn,
Why were you using the formula for the standard?
I'm sorry, why was I using what?
The standard deviation.
Yeah,
The formula is for.
Yeah.
for
Population?
the population.
yeah. If I may, let me pause that, because we're going to talk about that when we get to the chapter 12 spreadsheet. So, if I may, let me pause it until then. Important question, important question. Other questions? Okay. Whew, I hesitate to move to the next one. The next one that I put together is, oh, there was another mistake in it that I found yesterday, but I fixed it, so okay. Probably not the greatest example of a growth strategy. So we looked at absolute value, we looked at relative value. Growth strategies are where you're looking for companies that are obviously, experiencing a hyper growth to them. Okay, I'm actually not a big fan of those strategies. I used earnings per share out of convenience. So what I did here, again, same stocks, but what I did here was just put together an example of where you're going to look at the earnings per share changes of each stock. Whichever one changed the most in year one is the one that you're going to buy and hold for year two. So at the end of 2012, we're going to look at all of our earnings per share for each company. And whichever one changed the most from 2011, whichever one experienced the greatest percentage increase in earnings per share, then we'll buy that at the end of 2012, and that's what we'll hold for 2013. At the end of 2013, we'll repeat the process. Look at all, and that's what we'll hold for 2014, et cetera, et cetera. Again, probably not the greatest example of a growth strategy, but at least one. Okay, so does that make sense? Okay.
Is that a typical growth strategy?
No, so probably not. I mean, if I were...
It was just something like you kind of made up?
Yeah, I mean, I think, maybe a better example would be sales,
Yeah.
But there's a couple of problems with that. Number one, earnings per share was easier to get. Actually, I could have gotten sales easy too, so I could have done sales. But sales is before management, managing the company. So you could have, a lot of sales growth, but then managers are, you got your agency cost. So they're not managing the assets optimally, so you're kind of ignoring that. Nonetheless, I think if you were doing this,
It's kind of, I mean,
I
like,
don't know, what would you do?
I mean, what I've kind of got is it's kind of like more discretionary. Like people decide it's a growth stock, I guess they'll look at, earnings per share if it's increasing year over year.
Which is what I'm doing here.
Right, sales too, but I mean, just from looking at Apple, they'll try to, they're trying to people say they're trying to transition from value to growth, or from growth to value. So I don't know, I was just like, because that's not really how I invest, but I was just wondering,
Well-
like, what are typical strategies for those?
And using that as an example, if you looked at Apple, and really with Apple, if you looked at either sales or earnings,
Yeah.
okay, at least in recent, Apple's been around a long time, but in recent years, looking at either one, you'd probably see something like this, and then with iPhone and the iPad and all that, you would see this, and now we're getting back into that. At least I hope we're not, I hope we're still doing that, but that remains to be seen. So regardless of what proxy we use, or, and you'd probably use, if you want to do it in real life, probably use both of them. Look at both earnings and sales, because that then takes into account management efficiency. But regardless, what we're looking to do is buy the stock before it starts experiencing this growth. I've got an example on here that I did with Apple from a couple of years ago. Apple's stock price at that point was $262, I believe. Well, it ran up to $700 last year. That's what we're looking for in growth stocks. That's what we're looking for. So we want to buy it back in here and sell it at $700 like I didn't do. Trading the left-hand side of the chart is always easy. So I bought at 400, wrote it up to 700, now we're back at 400. And I'm stubbornly hanging on. Okay. So point well taken.
Just like from what I've viewed, it's like a lot of there's discretion within it. Now, typically, as well as for growth stocks, they usually what I've come when people invest in growth stocks, they're not looking for dividends, or they're not even looking for companies to have dividends.
I would agree with that.
Okay.
Yeah. Well, yeah, because if a stock's price goes from 262 to 700 in what, 2 or 3 years, I'm not worried about a 3% dividend. Yeah. That's good enough for me. And that's actually, you could probably dial that into your strategy in the real world. Because in addition to sales increase, in addition to earnings per share increase, you might also look for stocks that don't pay a dividend. Because you don't want them to pay a dividend, because you want them to take that money and plow it back into their positive NPV projects. So that might be a third variable. And this is before we even talk about the tenure of the CEO and all that kind of stuff. Okay. All right, so with that, these are the earnings per share changes for each year. And after that, everything is pretty much the same. Okay, so all I'm doing is going through, so again, we've got our equally weighted benchmark. Again, whichever company had the highest earnings per share, highest change in earnings per share for year one, you're buying that and holding it for year two. Okay, so it's really the same conversation after that. So here is your equally weighted portfolio, and here is your growth strategy portfolio with the related results. And how does growth strategy do? Relative to the benchmark. I didn't think that would be stinks. Even before we calculate numbers, we've got a lower return and higher risk. Before you even break out your calculator, you should stop right there. Okay? And then quantify it with your Sharpe and your alpha and all that. Okay. And again, same thing using the S&P as a benchmark. And it actually did outperform the S&P. Whether or not that's an appropriate benchmark is yet another benchmark error conversation. Okay. Again, just an example of a simple growth strategy, certainly not the only one like we've been talking about. Make sense? Okay. Last one, and then we'll move on, is an example of a very simple technical analysis approach. And this would probably be easier if I showed it to you. So, McDonald's, for example, I guess would be a good example, whatever. All right, so let's look at a 2-year chart of McDonald's. And again, with technical analysis, what we're doing is we're looking at past prices to make our decision. We're looking for patterns in past prices that repeat. Okay? And a very, very simple strategy, which I'll leave that comment for later, is simply using what's called a moving average crossover strategy. Okay? And what we're going to do, and I used a 50-day moving average in my examples, and this is either a 50-day or daily. So this is a 50-day moving average here. So this is a moving average of the prices. So for any given point on here, this is the average of the prior 50 days. Okay? And the idea is pretty simple and pretty intuitive. And that is when prices cross above the moving average. I hear it from the Young Investors Club all the time. They're posting all over Facebook, hey, it crossed above its 50-day moving average, or 200, or whatever it is they're using. Okay? Well, if it the intuition is very simple. When it crosses above the 50-day moving average, or whatever moving average it is, that's good. Prices are rising. And therefore, we're going to want to buy. If it crosses below the moving average, that's bad because prices are going down, and we're going to want to sell. Easy enough? Okay. Now, is that easier than all the other strategies? The other strategies, yep, okay. The intuition is easy. And if stock prices, I'm running out of boardroom here, if stock prices were like that, then it would be easy, because our moving average would be something like this. The problem is that in addition to this market condition, what you can get are markets doing that. Okay? And you can see that from the chart. So what we're trying to do with this type of technical approach is we're trying to buy, see look, we crossed above the moving average. Okay? So we're trying to buy, and then sell up here. Okay? If we wanted to go short, then we're trying to sell, okay, when we crossed over, boom, 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 and then cover way down here. That's what we're trying to do. But there's a reality. And the reality is, look at all this whipsaw in here. Okay? Look at all this up and down movement, because even right in here, look how many we'd be selling there, and then buying back there, and then selling there, and then we're short all this. And we've got probably a dozen trades right in here before we get to this. So while it's true that we would have made, and if you don't believe anything else about moving averages, believe this. While it's true that we would have made money from here to here on this very simple strategy, we would have given all that money back when we get into these periods right here. Look at that. We would have given it all back during those times. That's the problem with moving average strategies. But that's what again, I could do a whole semester, probably do a whole degree on technical analysis. This is kind of the starting point, because everybody, you always hear moving averages. Okay? And this is just using one. We could use two, we could use on and on and on. So anyhow, that very simple idea is what I'm illustrating right here. Okay? So I use daily because 50-day moving average is commonly used. So I switched to daily prices here. All right, so we got the prices. Here are our holding period returns. New divided by old minus 1. Here is the moving average, the 50-day moving average of prices. Okay? Maybe kind of putting all of these in perspective. Okay? This is an example of modeling your trading strategy. All these four strategies that I've been telling you about, this fourth one I'm getting on now, they're all examples of modeling your trading strategy. In my opinion, you have to do that to determine whether or not your strategy is any good. Just because you made money on something doesn't mean it's good. And just because you lose money on something doesn't mean it's bad. I'm going to prove that to you when we get there, which will hopefully be today, but we'll see. Okay? So that's what we're doing, and like I said, this is where the work begins. So here's our moving average, and I actually broke it down into three where you would just take the buy signals as it moved above the moving average. You would just take the short signals when it moved below the moving average, and then when you would take both of them. Okay, so over here, that's what I have in this cell, is the day before. Okay, so notice that this is for row 16. If prices were greater than or equal to the moving average, which is in and of itself a conversation we could have. Should it be greater or should it be greater than equal? So not many would fall in that category, but a few would. Okay? So if prices are greater than the moving average, which is what I just calculated over in this cell here, then you would have that returned for the next day. And if not, you wouldn't have it. Okay. So everybody understand what's going on right here? Okay, so this, again, very simply, if prices are above the moving average, we're long. If they're below the moving average, we're out of the market. That's the simple sum. That's columns in through Q. Columns R through U are the opposite. If prices are below the moving average, then we're short. If not, we're out of the market. Okay? And then the last one is if prices are above the moving average, we're long. If it's below the moving average, we're short. Yes. Yeah, because if prices went up, which is a positive return, and you're short, then that would be a loss to you. Okay, so is that easy enough? And I've got the, I have the performance up top here. So it's the same ones. I just put it up top instead of bottom. So we still got our average return standards, so forth and so on. And by the way, you'll notice that I have the if statement in here just to make it a little easier to read whether or not you beat based on Sharpe ratio and whether or not you beat based on the alpha. Okay? So notice that all the stocks beat the market over this time period all by themselves. If we had gone long, then relative to the buy and hold strategy, for most of the stocks, for the overall market and for IBM and McDonald's, we would have beaten based on Sharpe ratio, and here are your alpha results. So, exam question, using the Sharpe ratio analysis, would you have outperformed the market? More specifically, using the Sharpe ratio analysis, assuming a risk-free rate of 0, would you have outperformed the market? Similarly, using alpha, assuming a risk-free rate of 0, would you have outperformed? Okay. So the long side actually looks pretty decent. The short side stinks. And then going both long and short doesn't look very impressive. Okay? So based on this, over this time period, the intuition there would be, hey, using the 50-day for a buy signal looks like it might have some value. Keep in mind, though, that this includes 2008, which was, if I remember correctly, a 37% loss. That's unusual. Not unheard of, but unusual. So if we took that out, I don't know how it would change things, but if we took that out, I suspect that it would change things, simply because this long-only strategy would have gotten you out of the market before that happened. All right, so again, the point of all that is just giving you examples of each of these 4 real-world approaches. And I'm a little confused / concerned that, because I'm getting the sense that particularly with the other 2 that I did, that seems like a big mystery. So if we need to go home and look at that, if we need to talk about that some more tomorrow, then let's spend some time doing that, because they're actually very simple. And these are things, and I don't mean that in a demeaning way, I mean that because as graduating finance majors, this is something that I would want you to know. Basic approaches to investing. Basic approaches. Okay? So I mean that sincerely. Okay? All right, so questions about any of that before we move on? Questions? Okay. Just to get rid of this spreadsheet, I'll shift gears a little bit here. I thought about including this into chapter 12 instead, but I'll just leave it here. One of the things that you really want, if you're going to get into investing for real, one of the things that I really recommend is that you learn as much about probability theory as you can. Okay, because that's one of the key ways we distinguish between luck and skill. Like I've been telling you for a couple days now, and I will continue to tell you for the rest of the semester, okay, there's a big difference between luck and skill. I mean, if you think about it, you know, the market average, you could argue that that is like the average performance of all of the investors out there. So by definition, in any given period, about half of them would have outperformed the market. But that was by luck, not by skill. I mean, let me put that another way. You could do that simply by luck and having no skill whatsoever. Okay? So learning basic probability theory is important. And what I want to show you on this spreadsheet is another way you can benchmark your results. Okay? We do this a lot in academics, and I think it is underappreciated in practice, because I don't personally know of anyone who does this in practice. I'm sure someone somewhere does. But we do this often in academics, and like I said, I think it's underappreciated. And that is modeling the stock market. Okay, so using Excel, we can generate a random market. Okay, it's funny because in all of my readings, every once in a while I'll run across what they call a random market strategy, when in fact it's not. It's them randomly jumping in and out of the market. It's not having market returns that are random. Okay? And modeling random returns, I believe, is important, because what does market efficiency say about the distribution of returns? And I know you guys talked about market efficiency. If you tell me you didn't, I'm going to ask you who you had for investment now, so I'm going to go ask them myself, because I know you talked about market efficiency. Okay. What does market efficiency say we would expect in the distribution of stock returns?
Evenly distributed?
Yeah, well, they would be not equally distributed, but randomly distributed. Okay? Because if market efficiency, as you know, says that all information about a stock is going to be discounted into the price of that stock. Right? This is a market efficiency, and this is critically important because this is our challenge in investing. Okay? We're all trying to beat the market, and the model, it's not really a hypothesis anymore, but the model of market efficiency says you can't do that, because the result of it is randomly distributed returns. Okay. Market efficiency, all information about a stock is discounted into the price of that stock, which means what's going to move the stock is unexpected news, right? Unexpected news has to be randomly distributed Because if it wasn't, that would become part of the expected moves, right? You had those conversations? Stock returns are going to be driven by news, right? New information that comes in, right?
Yeah.
Okay. We can break that information into two components. Expected and unexpected. Okay? The Fed is going to have a meeting on whether or not to change interest rates. Well, when that meeting starts, the market has already formed expectations about the result of that meeting, right? Those expectations have already been built into prices, right? Okay, so if the Fed does what the market expects it to do, then how would we expect prices to change? Go up, go down, or stay the same? Stay the same because they've done exactly what was expected. Therefore, what's going to move prices is the unexpected portion. Right? Okay. The unexpected portion, theoretically, and I guess you could say in practice as well, but the unexpected portion would have to be randomly distributed. Which means sometimes the news is better than expected, and sometimes the news is worse than expected. Noticing that that would all average out to 0. Right? Because if the market always underexpected, just for example, okay, let's say 90% of the time, let's say that 90% of the time the market was wrong and news was actually better than expected. You with me? That would then become a part of the expected, because you guys are all smart people, and you would sit there and you would look at the past and say, yeah, but the market's always wrong. So what are you going to do? You're going to buy because there's a 90% probability that the news is going to be better than expected, right? Well, you guys are smart, but you're not the only smart people. So everybody's going to be doing that. And what does that do to prices? It raises prices. Hence, the information is discounted into prices. So, for that reason, the unexpected portion would have to be randomly distributed. If that's randomly distributed, then so too are the returns. I mean, that's kind of the short version of that, but I think that does it justice. Make sense? That's huge. That's critically important. Because if it is truly randomly distributed, then you can't forecast it. Right? If you can't forecast it, then you can't beat the market. Now, I actually had a reviewer argue with me about that one time. There was some, I don't even understand the guy's argument, assuming it was a guy. I don't even understand the argument. But if something is randomly distributed, then by definition, you can't forecast it. Right? And if you can't forecast it, then you're left to buy the market. Buy the market portfolio. Okay? So my point being that in my view, in my opinion, modeling a random stock market is an important task. It's important to be able to do because this is one of your benchmarks. This is one of your benchmarks. Okay? So what I've done here first is I've given you just a simple game, like a coin toss. Okay? And really, in my opinion, for practical purposes, most of the probability theory things that we need for investing really boil down to as simple as a coin toss. Heads, you beat the market. Tails, you underperform the market. Okay? And that's what I've got here. So I've got a game, and I put all this in here. So I've got a game where, flip a coin. Heads, you win $1. Tails, you lose $1. What's your probability of winning $1? Assuming it's a fair coin. 50%. Okay. Therefore, over time, what's your expected profit from that game? 0. Intuitive enough? Well, this is modeling that game. Okay? And what I've got here, the first day of class, I told you guys that on the exam, I wasn't going to test you on Excel functions per se, but I did tell you that there was one or two exceptions to that, and this is one of them, okay? Make sure you make note of this function right here, the RAND, R-A-N-D. Okay? This is one way, not the only way, but one way that you can generate a random number with Excel. Okay? So this number, or excuse me, this function generates a random number between 0 and 1. And for the record, it's a uniform distribution. And that'll be important when we get over here. Okay? Uniform distribution. So everybody understand that? Okay? And then the game is what I have in column B. Okay? So it's generating a random number. So this is mimicking flipping a coin. So I'm saying if this number is higher than 0.5, then you win $1. If it's less, you lose $1. Actually, I'm saying if it's less than or equal to, you lose $1. Okay? So far, so good? All right. One of the nice things about Excel is that rather than like we used to do in a middle school, actually flipping a coin 100 times, we can generate a lot of simulations very quickly. Okay? And the return that I have here is simply the sum of all of these games. Of where we're flipping a coin, we're playing this game for however many times. I think it was like about 3,000 that I just did right there. So that's playing the game where we're flipping a coin 3,000 times. Okay? This is basic probability theory, intuition of which is critical when you're developing investment strategies, in my opinion. I wish I could get that across to the Young Investors Club. I did a presentation for them last year, and I don't think I got anywhere with it. But I'll get you this year, Tony. I'll get you guys this year. So this is the result of the game. Make sure you write down also that if you hit F9, then it generates another random number. So notice that every time I hit F9, the numbers are changing. That's because it's regenerating a number. Okay? So far, so good? All right. Absolutely critical to understand for investing. What I just said a minute ago was that whatever investment strategy you're doing, one of those four, whatever it is you're doing, okay, just because you made money doesn't necessarily mean you know what you're doing. And just because you lost money doesn't necessarily mean you don't know what you're doing. Because there are probabilities at play. You all know, because you just told me, that in this game right here, your expected profit is 0, right? Okay. Well, we have, almost 6,000. We have roughly 6,000 plays of this game. As I hit F9 to do another 6,000 and another 6,000 and another 6,000, notice how many times we get a total return of exactly 0. That's actually pretty darn close. So that was 30,000 plays right there, hitting this 5 times. Another 5 times. So that was a total of 60,000 plays that we just did. And not one single time did we come up with exactly 0. That's why I said a minute ago when we were looking at the value of $10,000, I don't remember if I said it wasn't very convincing or something like that. This is why. Okay? So far, so good? All right. Notice also that if we look down here, notice that we have 1, 2, 3, 4, 5, 6 times where we were exactly correct. We got 6 heads in a row. The probabilities tell us that we should have gotten no more than 3 over that 6. But, look, we're on a hot streak. We're on a winning streak. We're making a lot of money. Does that necessarily mean that you're doing it by skill? No, that's what the probabilities tell us. I was talking with someone about their real-life trading strategy one time. This was years ago, and I admit that at the time it caught me off guard. I don't remember exactly what we were talking about, but he said something to the effect of, on the last 11 trades, I've made money on every single trade. Therefore, that proves that my results are not random, that my results are based on skill and not luck. And I admit that at the time it kind of caught me off guard. I'm like, okay. But, after I thought about it a little bit, is that necessarily true? No. Not only is that not true, furthermore, if we play the game long enough, we would expect 11 heads in a row. Because if we never got 11 heads in a row, then when we got 10 heads in a row, we knew what the 11th flip was going to be, and that is basic probability theory. Okay? So just because we have these hot hand winning streaks doesn't necessarily mean that we just didn't get lucky. In fact, this is important for you to know. All of this is important for you to know. Let's say that your probability of outperforming the market in any given year is 50%. Okay? Then in 1 year, what's the probability of outperforming the market? That's a tautological question. 50%, 0.5 to the 1. If your probability is still 50%, what's the probability of outperforming the market every year for 2 years? 25%. Every year for 3 years? 12.5%. Etc., etc. Point being, make sure you write this down, because I know you're getting tired. But hang in there a minute. I want to get through this, because like I say, we're probably not going to have class at all on Tuesday for a short one. So let me get through this and we'll be out here. This is critically important. I mean, you should want to stay with this. Okay? This is the probability of, I don't know why I put that point in there, but this is the probability of beating the market each and every period for n number of periods. Okay? So again, if our probability of beating the market in any given period is half, and we're looking at a 3-year period, then our probability of beating the market every single year for 3 years by sheer dumb luck is 12.5%. By sheer dumb luck, we can do it. That's important, okay, because, well, for a lot of reasons, one of which is if our probability is 12.5%, how many professional money managers are there out there that are actually trying to do that? And I'll make it a little easier, just in the U.S. How many of them are there?
Hundreds of thousands.
Yeah, I mean, who knows? I'll even say just 10,000. If there are 10,000, that's critically important. You should want to stay here till 8 o'clock tonight to hear this. If there are 10,000 money managers, only 10,000 trying to do this, and the probability of actually achieving that 3-year track record by sheer dumb luck is 12.5%, then how many money managers would we expect to do it by sheer dumb luck? What is that? 1,250? So by sheer dumb luck, we would expect 1,250 money managers to beat the market every single year for 3 years and not know what they're doing. I'm exaggerating a little bit. The problem is, when we go on CNBC and when we open our trade magazines and all that kind of stuff, who are the people that are going to be advertising on there? Those 1,250 people. That's who's going to be advertising on there. Okay? And they may not even know they just got lucky. And maybe they didn't get lucky. Okay? one of the things that I told you before, suggested to you, and I would argue it to anybody, is that the real difference between luck and skill is causality. Remember we talked about spurious relationships? That's how you tell the difference, which is a whole nother conversation. That's how you tell the difference. Because I admit, somebody beating the market every year for 3 years is enough to even get my attention. Okay? But understand, we can do that by pure luck, 12.5% of the time. Okay? So understanding this is absolutely, absolutely critical. These are called runs, by the way. So just because you have a winning streak doesn't necessarily mean you know what you're doing. And just because you're having a losing streak doesn't necessarily mean that you're stupid. Because any business you get into has winning streaks and losing streaks. Okay? All right. I guess I'll go ahead and stop there. Tomorrow we'll pick up with this because this is using the same concept.